If time is an indication of persistence, aim and foresight, the foothold of foreign banks in China for over 100 years now could be testament to their stance in the country, capitalizing on what they do best, bridging the gap between China and the Western world. These foreign banks now also count Chinese companies as their clients, beyond just the multinationals. In the past 10 years, total assets of foreign banks, a crucial matrix for the sector, have increased from 1.3 trillion to 2.9 trillion yuan. Their share of China's entire banking sector, however, has fallen from 2.4 to 1.3%. Foreign banks urge to look beyond this measure.
We're not here clearly to compete on the same thing. If you look at it from a slightly different angle, the risk management expertise, the products expertise, as well as how do you operate a bank on a global scale. I think that is something that we have contributed greatly to this market. So I would say both foreign bank and Chinese bank are major contributors to this market, and I think this market will not be as interesting without either one of them.
In the Chinese market per se, it's very difficult to compete against Chinese banks because they are very strong, and here locally we have not much competitive advantage. While if we look at then our international footprint, also some area of expertise in natural resources or acquisition financing, also all those are areas where I think we can bring values, and we have tried to build on that.
Furthermore, with only $1.1 trillion or so committed to China's Belt and Road Initiative so far by the AIIB, Silk Road Fund and the New Development Bank, against an estimated 1.7 trillion needed per year in Asia up until 2030, extra funds are needed. In June, Deutsche Bank cemented its commitment with a $3 billion deal with the China Development Bank to finance infrastructure projects under the Belt and Road Initiative. Meanwhile, Societe Generale says it has set up a Chinese desk in each African country as commercial activities between China and Africa pick up pace. China has been gradually opening up. It first joined the World Trade Organization back in year 2001. And in year 2007, foreign banks were allowed to set up locally incorporated operations in China. A decade later, just 3 weeks ago, China has further liberalized its financial sector, allowing foreign companies to now hold a majority stake in joint ventures with Chinese securities and insurance firms. The opening up will also raise single foreign ownership limits in Chinese banks and asset management companies. While a timeline of this proposal has yet to be disclosed, Societe Generale is gearing up to take advantage of this news.
We would love to be able to have the licenses to open a security. We have looked at it for many years, but we were blocked by the fact that it's very complicated to share risk appetite. The fact that we could be a majority shareholder means we are ready to invest and to open up a security.
Going forward, Gaofeng expects the Chinese capital market to be much more open to foreign capitals, with the renminbi internationalization and Chinese stocks being added to the MSCI Global Benchmark Equity Index.
So globally, everybody will have a reallocation, but they need to look at China much more seriously. And I think we are in a sweet spot here, right? We're in the middle, and we're going to facilitate that flow. And if we do that well, hopefully the world understands China better, and Chinese investors or Chinese company understand outside world much better, and in that case it's a win-win situation.
And as such, despite their small share, the message is clear for these foreign banks in the Fortune 500 list. China, with its 1.3 billion population and 80 trillion yuan economy, is still one market that cannot be dismissed. Lynn Tang, CGTN, Beijing.